Welcome to the show. I'm Andy Hagans, and today we're talking about commercial real estate opportunities in the 2023 market. Very interesting times. And joining me today is a very interesting family office and asset management firm with a unique strategy. I'm speaking with Daniel Farber, who is CEO at HLC Equity. Daniel, welcome to the show.
Thanks a lot, Andy. It's great to be here and great to meet your crowd.
Yeah, absolutely. And so we're going to be talking about a lot today. I want to get kind of a macro landscape type update, because I know you're involved with a lot of CRE investments and assets. But before that, I'd like to get your backstory because we've had several different family offices on the show. And you know what
Yep.
they say, if you know one family office, you know one family office. So
Yep.
you all have grown from being a family office into being an active GP slash operator slash sponsor. So could you tell us a little bit about HLC Equity and how you've evolved over time?
Yeah, sure, definitely. With pleasure. And you're right that saying is very true, and it's very true with us. So the quick kind of history and story of our firm is basically it wasn't this situation where it was a family office and you just kind of knew that it was a family office. Basically, my grandfather was a very ambitious individual who ended up having some success in business, and with that success in business, ended up building out a real estate portfolio. And for a long period of time, it was essentially kind of like a real estate portfolio of family holdings. And at a certain point in time, I, growing up, did not ever have in mind that I was joining any sort of family business or necessarily that that's even what I was going to do. I was on my own track. I actually became a journalist at the age of 16 as an intern, and then later kept on doing that. But, life takes in all kinds of different directions. And after working in both journalism and in politics, I kind of really realized that my passion was in business. And so then it was a matter, well, how am I going to build out my world in business? And just by chance at that point in time, and in the family holdings, that they were kind of like trying to figure out what they were going to do. And they asked me if I would join the firm. And basically, the idea was, if I'm going to join the firm, we're going to build this out into something, bigger than what it is today. And that's going back to like kind of 2008, 2009. And that's what we've been working on, and that's what we've been doing ever since. So we went from being just a pure kind of family office, family holdings, very kind of, management, but also not managing a lot of investors and stuff of that sort, to now being a proper sponsor where we have hundreds of investors that we serve. And, we have a whole management team built out with over 50 employees. And so, yeah.
Yeah, it's interesting. Every family office is unique, but that's actually a story, kind of a similar path that I've heard from a couple of guests that we've had on the show, which is, you have a patriarch that builds a fortune, if I can use the term, builds a fortune and
Mm-hmm.
whatever. I mean, it could be anything, right? It could be plumbing supplies or whatever.
Sure.
So they build a fortune, and then they basically start the single family office,
Mm-hmm.
start investing in real estate. And then it's the nature, at least in my experience, the nature of family offices, they're very cooperative. Sometimes they'll tend to do deals together. So it ends up being, a family office, then maybe starts working with a couple partners, a couple other family offices.
Yeah.
And then next thing you know, it's like, well, we are kind of doing investor relations. We are kind of doing all of these things that an asset manager would do. So
Right.
it's almost as logical to take that next step.
Yeah, 100%. And it's very, I mean, like you're right on, and that's exactly what's kind of happened within our family. So we have it started out like we just had partnerships with some people that we felt very close with, where it was kind of like pari passu in going into deals. And then that developed into, okay, well, we're doing this. And so, and then it's also, well, what do you do? Do you continue to do that and just like kind of sit there and, manage what you have, or do you try and grow? And I think that, especially, people who are brought up with a certain value system, it's not necessarily what you have, but it's what you have and what you do with it. And so you say, okay, well, how are we going to grow what we have? And that's just like kind of a natural progression. And it comes with its own challenges, right? Like, you hear sponsors who put together their own portfolio coming from nothing, and that's amazing and a huge challenge in and of itself. And but when you're trying to build out kind of like you have a certain system, and a lot of times there's certain challenges that you can't even imagine because it has to do with family dynamics, politics, what's the
Mm.
strategy. You can't take nearly the risk that other people would take, right? Which can bind you in a lot of ways. So it's a different dynamic, but it's definitely kind of like a natural progression that we've taken, and it doesn't surprise me that there's a lot of other businesses that have gone a similar route.
But it's not, to be clear, I'm not saying it's like the well-trodden path of family offices, because
Right.
to your point about family dynamics and the relationship aspect, I think to go from like a single family office to then being a sponsor and to having, let's say, hundreds of LPs or dozens or hundreds or whatever, maybe thousands of LPs someday
Yep.
in deals, you have to professionalize, right?
Yep.
Because let's be honest, like a lot of family offices like just aren't very professional. Would you say
Oh
that's
yeah.
accurate?
Yeah. Oh yeah. When I brought this strategy to kind of like the management within the family, and a lot of them are attorneys, and the
Mm.
first reaction is like, A, why would we want to share all of these great investments we're doing? B, why would we want the liability of all of these investors on our back? Right? Like those that and then like it and then there was a whole alphabet of other issues. But so the mindset of like, okay, why are we doing this? Why do you do this? It doesn't make sense is a big shift. There's a big major shift that needs to take place, that
Mm.
took place in our company of like being one of like kind of like the holding versus the growth. And it's funny because I used to get invited to these family office events, and a lot of them were like, okay, well, you can only come to our event if you're like a single family office or if you're just investing capital, right? That's the only way you can come. So I used to get invited to all these events, and then I got some, and I honestly I didn't find a ton of value out of the certain ones that I went to, but I basically got put in a position where now they said, oh, well, you're raising capital now for your deals. And I was like, yeah. And they're like, so you can't come to our events anymore because you're raising capital. And I was like, so you basically want only family offices where there's like a bunch of people and they're not working, they're just writing checks all day. You don't really want like entrepreneurial, like people that are going out there and trying to, develop and grow things. So it was kind of disenchanting to hear that, but such is the world.
Yeah, it's almost, the difference between, the former kind of family office that you reference. It's almost just like a really, really big LP, right? Just
Yeah.
like
Right.
an
Yeah.
LP writing really big checks. But to
Right.
me, I mean, even a smaller family office, in my experience, not always, experts at everything. Like I think sometimes there
Yeah.
are knowledge gaps in smaller family offices, but I think you do see a lot of entrepreneurialism, like looking for GP, LP, or co-GP deals.
Sure. Yeah.
Um,
I mean, it's like you said, every family is different, right? And it really has a lot to do with the values that are brought in. And so, like my grandfather, when he was 90, he must have been 94, and he was just 24/7 on the clock working type of person, child of the depression. That's just what he did. And I remember I said, hey, you've done well for yourself. Why don't you go down to Florida and enjoy yourself? And he could not even believe that I was saying that. And his response, having grown up during the Depression, was, "Are you joking me? I have seen people go from having everything to having nothing in a matter of days, and
yeah.
there's no way that I can't work." Right? Now that's an extreme, but I'm just saying, like, I think that those values and that work ethic is definitely, it's in some groups, and others may have slipped or not had. I can't speak to others. I just know that within us, that's kind of where the entrepreneurial drive comes from.
Yeah, it's interesting. Jimmy and I, my co-founder here at Wealth Channel, we call them the three phases of wealth. There's kind of that initial accumulation stage to kind of where
Yeah.
a person saves their nest egg. And then there's that phase two, where, you switch from you have to work all the time to now you're becoming a more passive investor, because at some point your assets begin to have more earning power than you do, if you've been successful and if you've invested well. But it's that third stage, to me, that's the most interesting, which is where you're creating a legacy and your
Hmm.
wealth is now, it's going to live on beyond you. And I think that's kind of the
Hmm.
heart and soul of a family office, is the idea of legacy. But I think it's a challenge, where, kind of what you're, to your point of a patriarch had a very different upbringing and even a different mindset than the
Oh
second
yeah.
generation or third
Yeah.
generation. And you're
Hmm.
not going to be able to replicate that exact mindset, right? I'm thinking of
Nope.
like, maybe not so much anymore, but like patriarchs who started family offices who went through World War II or something. It's
Yeah.
like you're
Yeah.
not going to replicate that mindset in a
No.
millennial or Gen Z or something. It's just not possible. So, in your experience, when you have multi-generational family offices and you're trying to transmit those values, where do you see that succeed or maybe not succeed with ultra high net worth families that are able to imbue that family philosophy and the philosophy of hard work and thinking long term to the subsequent generations?
Sure. Well, so first and foremost, like, seeing is believing, and, things aren't taught, they're caught, right? So first and
Yeah.
foremost, it's whatever is seen, within the actions that leadership show, right? And then, when you speak about legacy, I mean, like, that can mean so many things. For me, it's more about values and what you're trying to, give over to your children. Now, I have children, and what type of values are you trying to give to your children? But I definitely think that when it comes to work ethic, it's something that that you see. And then for us, I mean, our purpose, it's built on legacy, creating thriving communities. And a lot of things that we do are community oriented, both in business and in the philanthropic world. And so I think that kind of like when you have those things and they're spoken about and acted upon on a regular basis, that it kind of, hopefully sinks in. Another really important thing, I think, is that people understand that just because it works for one person doesn't mean it's going to work for another one. And then everybody's going to have their own ways. And, so people shouldn't necessarily be working in a certain business because it's maybe not what's the best fit for them. They should be doing what they want to do in life and what they feel their calling is in life. And just because one person ran a business one way doesn't mean that it should have been run the other way by the next generation, or by, and vice versa. So I think that there's a lot of nuance and dynamics that goes into here. I don't think that there's set rules. And honestly, I don't think that anybody has the exact code. I think that some groups have been able to do a good job. And whether that's, everything they did and pure intention, or a mixture of intention and luck, we'll never know. But I think it's a mixture at the end of the day of both of those, I think.
Yeah, no, well, personally, I'm going to discount the luck portion of it. You hit on two themes that I thought were really interesting. The first one was just kind of that holistic. I don't know if you used the word mission, but just like you talked about how your businesses and philanthropy are community oriented. And I
Mm-hmm.
think when a family, this is any family, not just ultra high net worth family, but when a family has a shared mission and a shared purpose that's,
Mm-hmm.
external to the family, and like
Mm-hmm.
you said, more is caught than taught. And I
Yep.
think then that's being part of a family. Well, what's our mission? This is what we do. You kind of learn that growing up, and it kind of gives you something, even with a father and a son, or with brothers, something that you're doing together, or
Mm-hmm.
siblings, I should say
Mm-hmm.
brothers and sisters. So I think that mission oriented component of is really important. And then the other
Yep.
thing you mentioned to me was flexibility, and again, I think this applies to any sort of family, not just family office, but just not every child is going to be the same. Not every adult is going to be the same. Different businesses are different. And then also there can be different management styles or different valid ways of running a business. And you don't always have to look at it like black or white, my
Sure.
way or the highway. And probably if you do, you're probably just setting yourself up, for failure. And your company is over 70 years old. I mean,
Mm-hmm.
and in commercial real estate, I mean, even for family offices, commercial real estate, private equity, that's pretty old. I mean, there aren't a lot
Right.
of firms that,
Yeah.
we've had Inland on the show, and I can't remember if they're 40 years old or 50. But and to me, that's a venerable private equity
Yeah.
company being 40 or 50. So 70 years old,
Right. Yeah.
that's very rare. How does that longevity change the culture, the work culture, or the philosophy in the family office at the
Sure.
company?
Yeah, and it's changed right throughout that period of time. So like we're very much a people oriented organization now, where I think that that was less of a focus once upon a time, and that also goes into like I'm just a very like I recognize I need great people on the team to do some great things, and that's what we've done. That wasn't necessarily the prior approach, just in terms of growth. And so I think that it's a mixture of of kind of like understanding that you're in a new reality. And again, those values do transform through the very different generations. And so nowadays, what we've done actually, and what drives our company today, is our employees have actually, some of them have been around for a very long time. They have actually defined our core values within the company, right? Not necessarily like the entire purpose, but within the company, where they came and they said, hey, these are what we actually live by day, right? So it was less like, hey guys, this is our values because I think this is important, but it was like, no, Daniel and family, this is what we live by, right? So it's caring, owning it, integrity, and ingenuity. But those
Wow,
were
so you
given by the
guys
people.
you guys did that bottom up. So that
Yeah,
wasn't like a top
yeah,
down
right,
CEO dictates to everyone, hey, here's what our values are.
right,
This was a
right.
collaborative bottom up approach. That's really interesting.
100%. Right. And like a 10 or 15-year-old company couldn't really do that, right? Because I mean, like they're going to have people coming and going. And then like,
Mm.
we were able to sit down with our team and say, okay, guys, we're doing this now as like a strategic growth. We're bringing in more better people practices. And so let's sit around the table and let's talk about what our values are. And I was quiet. And these are what they came up with after going through a bunch of different stuff. So this is our team speaking, which I think is very powerful. And you can only have in an organization that goes across decades. We have a woman who works in our company who has been at the company for as long as I've been alive. And then we also, what's very, like interesting is that is our relationships are very deep, right? We've had groups we've done deals with for over 50 years. But so when I first got in the business, certain people that I used to deal with, they're no longer here because some of those people used to deal with kind of like the older generation of the family, right? So I've actually seen like cycles of people go in and out of the business. So I think it's very informative from a industry standpoint and also just from a life standpoint to realize like we're here and then we do our work and we do as well as we can. And, it ends at a certain point.
Yeah, I mean, even that actually is really interesting to me because so many startup companies, and let's use the word startup loosely, it could be a 15-year-old company. The founder has been there the longest. I
Right.
founded it, and
Yeah.
for the life of the company until either, I pass away or I retire or whatever, founder and CEO led companies. Whereas you're a CEO, but in a way, you're not junior in the organizational chart, but in seniority, you have other people there who actually
Yep.
senior to you in seniority. And so I
Yep.
think that also speaks of you. I think that's, very wise to, listen to people
Mm-hmm.
who have been there a long time. And it's refreshing too, because I think, this might be a cultural thing. I think in America, we have a tendency to people are in the workforce, they hit a certain age, and it's kind of like, well, you're old, you don't understand how mobile phones work or
Right.
whatever.
Yeah.
Shove them out the door unceremoniously. It's very
Yeah.
refreshing for me to hear a totally different attitude of
Oh
like,
yeah.
we
Yeah.
respect your time and, teach us what you think, what you've seen in the past several decades.
Yeah, no, 100%. Also, the people who have been around for a long time, whether they're the most technologically, savvy or not, doesn't compare to some of the historical information or, just stuff that we come across. And we, being kind of like a family office and family enterprise, you have a lot of structuring and bureaucratic stuff you have to deal with. And it's very valuable to have some of those data points just come like, oh yeah, I remember in 1965 when this was done, and it's like, okay, thanks, I wasn't alive yet.
That's
Yeah,
amazing. Yeah,
yeah,
I
yeah.
love that. Yeah, all these Gen Z or whatever kids who are poking fun at baby boomers or whoever struggling to use
Yeah,
technology. It's like,
yeah,
okay, you know what? In defense of the baby boomers or older generations, they knew how to ask people on a date and socialize. Okay. The younger generation are socially, they're like totally non-functional. So let's just
That's right.
respect every generation has its weak points,
100%.
strong points. Well, let's
Definitely.
shift a little bit. This is so
Yeah,
interesting. Thank you for sharing that about the family office. I always love to
definitely.
hear about that. Very refreshing. I want to shift to, some of your research and some of your content that I've reviewed and just the CRE,
Yep.
excuse me,
Yep.
landscape in general.
Sure.
First of all, I should ask is commercial real estate and real estate investments, are those the main focus
Yeah,
of
that is our primary business and also the primary weight of our portfolio. Yes.
understood? So you said last year, and I have this in my notes, quote, the period of easy money during the cycle has officially ended.
Yep.
So, I guess I'm curious what this cycle means to you. Like, is this the foreseeable future? Is this 3 years, 5 years, 7 years?
Yeah. Well, I think that, so first of all, that came from a CEO letter that I write, and I, would love anybody who's interested. You can read the CEO letter on our website, and feel free to reach out. I love getting people's opinions and their thoughts because, this is just, for me, life is about a conversation. So there is no, I think that I'm right. It's just the way I view things. And I have no idea, honestly, because it's very hard to predict what the Fed is going to do, right? And it all has to do with the Fed. So, it was, during COVID, I was not able to predict that the Fed was going to rate or lower rates to such an extreme extent. It was pretty easy to predict what would happen as a result, i.e. inflation. So now they're in a very tough, point. And I think that it's very hard to see a scenario where they're able to tame inflation without keeping interest rates at least where they are, which historically is not so high. Compared to the last 10 years, it's high.
Well, it is and it isn't. I mean, here's what I would say with interest rates. It all depends to me their relationship with what bonds are paying, 10, 20, 30
Right.
year treasuries. Because when people reference, 60s, 70s, or 80s, I'm like, okay, interest rates were higher, but what were bond yields?
Right. Yeah. Mm-hmm.
Or it's like when people talk about interest rates being, X in the 60s or 70s when they purchased a home. And I'm like, yeah, but what in the nominal price of a home, what percentage of the median salary was a home then? So I
Right.
think when the
Yeah.
prices of these other assets, that in reference to the interest rates change, it does. I guess that's kind of what I'm getting at is,
Right.
are we indefinitely in a cycle of financial repression? Like, is that going to last for the
Yeah.
foreseeable
So,
future?
and just so I understand, you're saying that kind of like the incremental difference between what you could, like just to use a simple example, what you could borrow at and what you could get a home for, because homes were much cheaper back then in comparison to where the debt is, was
Yeah.
much different than it is today. Is that what you're saying?
Yeah.
That, and that also relates to all assets, right? Bonds and so on and so forth.
Yeah. And,
Yeah.
and just
So,
the idea that, bonds, yields are up and yields on treasuries are up, but they're still significantly generally, below the inflation rate. So it's still a
mhm,
negative real
right.
yield.
Right.
And that
So,
that to me, it's always seemed a little bit strange. It's pretty much been the case. It feels like it's been the case for my whole professional lifetime. I mean, maybe I need to like
right.
get the stats up.
Yeah.
But it's so it seems to me, it kind of like interest rates aren't that high historically. That's true, but it
Hmm.
seems like they're kind of high given where bond yields are.
Right.
I
I
guess is
hear
what
you.
I would
So
say.
you're saying that it's hard for you to see rates not going down. Is that what you're saying?
I don't know what I'm saying.
Yeah.
I guess I'm saying that I don't even know what normal is anymore.
Yeah.
Like
Right.
if interest rates are going to be higher, why aren't prices settling? Like it seems like, well, then prices should be getting swatted down, but we're
Right.
not seeing that too much in the bond market. To me, yields aren't as high
Well,
as they should be, and so it's
yeah.
just it's just hard. I guess, yeah. I don't know exactly what I'm asking, except
This is the real question, and this is why I say it's so hard to know because it's impossible to know how the Fed will respond. Um, if 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 we want prices to come down, right, and I'm talking about like asset prices to come down, then you have to get all the liquidity out of the market, obviously, right? That's what they're trying to do. That's going to take a lot of time given all of the liquidity that went into the market. Mm-hmm. And then the question becomes, and this is what I mean by what is the Fed going to do? We just saw them save banks, right? Whether that's right or wrong or whatever, that's what happened, right? So we know that there's trillions of dollars of loan maturities coming up, both on the corporate debt side and on the real estate side. Now, are they going to let those just all default? And if so, then like asset prices are going to come down, and they're going to have to bring down, and eventually everything will come back, and they'll go back to easing and so on and so forth, right? The question is, they propped up prices so much artificially. Are they also going to kind of like save things artificially once they start cracking?
Yeah, they are. I mean, they are, right? I guess that is kind of my question, is how do you even tamp inflation down when you signal to everyone that you're not really willing to drain liquidity from the market? Not if it's like serious pain, right?
Right. Yep. 100%. Right. So our overall outlook, basically what we're investing on, right? So, because I don't view my job as like, I don't need to predict. I just need to, kind of have my thesis of where things could go, and then also protect if they go the other way, because, we could be wrong, right? So our overall outlook right now is that we're investing in real estate. That's what we invest in. That's what we've always done. And the reason we do it is when numbers make sense. So we have not been huge buyers over the last 4 years. We bought some deals, but we have not grown our portfolio the way that we would have wanted to, simply because prices didn't make sense to us. We see, and I'm not talking about Armageddon here, we see prices are starting to make sense. They're not amazing. They're not, uber attractive. But we're looking at deals now where we can assume loans at, call it 3.5%. We're able to get some sort of, call it a 5 to 6% cap rate. Nothing amazing. We're not buying those right now, but we're definitely looking at them, and we have our hat in the ring. And so that's kind of like our overall outlook, because the way we see it is, yes, we could buy it and think, and the asset prices could go way down, but we would be able to weather the storm. And on the flip side, this may be a buying opportunity right now, and things may go back, and cap rates might, go back down to, levels that we couldn't imagine. I don't think that's going to happen, but it could. So that's kind of how we're looking. And also, I think it's important to note that, like, so this goes into our story of our firm. Our overall strategy of investing, I tell people that I have a very short-term horizon of 30 years, right? So I not really 30 years, but the point is that, you got to look at this stuff over the long term. We can get into kind of like private equity and the whole short-term hold, and why that, is good.
Well, Daniel, I have to say, I love the 30-year mindset. But that kind of brings back my point about financial repression. It's like, I have just learned that the markets can stay crazy for so long, and it's like you might need 30 years to wait it out. But you mentioned one thing, which is, it's beginning to make sense maybe to buy. You're not necessarily doing these deals yet, but if there's like a 5.5 cap, and you're able to assume debt at 3.5% or whatever, those sorts of deals, though, they're dependent on the ability to assume debt, right? Because you're not able to get new debt at 3.5%, obviously.
100%. Yeah. So the deals that we're looking at, they generally would have at least 6 or 7 years remaining on their loan until they mature.
Yeah. Got it. Okay. So basically, for you to find value, you're looking at value in both components. To me, that's almost built-in value just in the debt piece. Like, just having attractive debt is like its own form of value creation. And then a 5.5 cap, that sounds pretty good. I guess I'm curious, are you seeing that with like high quality multifamily, or what sectors would you be seeing those sorts of economics in right now?
Yeah, so we currently have 2 LOIs on in the multifamily space for those exact types of deals. Both, pretty high quality multifamily, not necessarily like uber class A, but kind of class B to class A deals. And the reasons for sales are not necessarily distress. There are groups that come out and they have to sell because they're a lot of funds. They have a 5-year hold and they have to get out now. And so that, so they're getting out.
Well, it's just, that sounds strange to me, Daniel. It's just, it sounds strange to liquidate when you have 3.5% debt, though. So you're saying it's more on like the fund structures forcing that liquidation, not some sort of liquidity crisis or debt problem.
Yeah, exactly. And that goes into the long-term outlook, right? Like if you sold in 2022, great. If you didn't and you have to sell because you have LPs and all kinds of institutions that have to get their redemptions or whatever, as opposed to just doing what our family's done forever, which is if it makes sense to sell, then you sell once in a while. But in general, you do way better when you hold on and you don't have tax events and you keep on appreciating and depreciating, right? So that goes into our overall philosophy of being more longer term. And I don't, everybody says that and, oh, we're so long term minded, but we actually have like the track record of investments that can show that that is really what we believe in, and we've gotten much better results as a whole because of it.
So how do you then structure? So like presuming, let's talk about your LPs now and broadly. I
Sure.
mean, we don't necessarily need to just discuss a specific product, but how do
Mm-hmm.
you then structure your offerings to
Yep.
allow LPs to come in and kind of,
Yep.
I presume you almost want to like set their expectations, obviously,
Yeah.
that this
Yeah.
isn't like a 5-year DST or whatever. This is
Sure.
very different. Then how do you
Sure.
structure the product though to align
Okay.
that, the LPs to have that same long-term philosophy
Yeah.
time horizon as you do?
Yeah, sure. So first of all, it's important. Like we serve now. So there's our overall how we've been able to build up a portfolio, and then there's right now what we do and what we're able to do, and so on and so forth. So we serve a wide range of investor base. We
Mm-hmm.
have family offices, ultra high net worth individuals, high net worth individuals, and then we have a couple private equity groups and wealth management groups that we work with.
Mm-hmm.
So depending on the project, obviously, if we have private equity and some wealth management groups, they want to know their exact time horizon. And so if it's a deal that we think, okay, yes, we can make it a 5-year deal. Worst case scenario, if they want out, we want to stay in. We figure out some sort of buyout with them so they can get out, right? So we
Sure.
do have that on certain deals, but we also have some investors who are also long term, mainly wealthy families that they say, like you are our arm of real estate investors
Mm-hmm.
or investment group. You are our real estate arm, and we want to place our capital with you. And when you feel that it's the right time to sell, we'll sell, and maybe we'll exchange and get into a different property. Maybe we won't. But for the meantime, we're there. We'll refi when it makes sense. And generally our terms are set between 5 to 10 years, just depending on the deal. But we have investors who we bought properties and we thought that it was going to be a 6% cash on cash, and now they're getting 10% on equity, and they're saying, why, like, don't sell, let's just stay in this, right?
Yeah.
So it really depends on the deal and the investor base that comes in, but very high level, we do like to keep things long term, which is not necessarily to the benefit of the GP, right? Generally it benefits LPs more than it benefits the GP, because
Yep.
usually we build up the GP value within the first 3 years.
Yeah, and a lot of GPs will have, acquisition fees, financing, a lot
Mm-hmm.
of those fees are transactional.
Yep.
So like the more offerings you have, the more activity there's more fee generation. But I think it's really interesting though, just products aside, just the culture of your family office and,
Mm-hmm.
partnering with other families. I think it can be one of those things that like attracts like. So, if you have LPs coming into your funnel, kind of learn
Yep.
about who you are and what you do. I think it's all about expectations. On that note, because you guys are at this end of the illiquid end of the spectrum and you're almost like proud of it, which I respect. And actually, that's a point I've been making a lot lately. There's all these intermittent liquidity products now, or these private REITs that have monthly, quarterly redemptions. You have interval
Mm-hmm.
funds, all these products. I don't have any, to me, they're neutral. Like
Mm-hmm.
I think product innovation can be a great thing.
Yeah.
Liquid to illiquid can be neutral, although I might almost argue it the other way, where I think illiquidity can be a feature, not a bug sometimes because of behavioral traps that investors can get in and things like that.
Sure.
But I'm kind of increasingly annoyed at these intermittent liquidity products or these intermittent liquidity REITs, because to me they're like half pregnant, that they
Uh-huh.
are, it's like you're either
Right.
illiquid or you're not. You're either
Right.
pregnant if you're not. There's no half illiquid. And
Yeah.
I guess do you have any opinion on that, or throw your hat in the ring on that concept?
Yeah, I mean, look, if it works, like the whole secondaries market, if it works, then that's great. For people to depend on it, I think is very challenging, especially now. Like, I don't know, like let's just say, I mean, open-ended funds, they make sense, right? If you can get
Mhm.
in and out, that makes sense. Up until now, like I don't know what it up. I really don't know the apparatus that open-ended funds are going to do if they have to mark to market now what they bought in 2021 and how people are going to get out, right? So it could potentially get messy. So yeah, I think that I don't think about it that much because I think that in our eyes, like I'm not the type of person that sits there with like a stock portfolio and says, okay, is the stock up today? Is the stock up today? I'm more of a person that says like, oh, quarterly, I have cash flow hitting my bank account. I like that, right? Like that helps
No,
me live.
totally.
Yeah. So I mean, I get it. I'm also kind of neutral on the whole secondary thing. Like we're not opposed to working with secondary groups if they can make it work, but I think you know, it's very hard to make any promises like, oh yeah, you'll be liquid because we have this secondary product. I think that's a very hard thing to promise people or to, even make any representation towards.
Yeah, it totally. Well, I do think one thing is interesting right now, though, that you mentioned, you know, uh, if some of these private funds or sponsors that are offering redemptions, if they had to mark to market right now, or
Mm-hmm.
maybe 6 months from now, presuming the
Yep.
asset prices might fall, that would be a serious problem. And I've had David Auerbach on the show. We talked about this some, and even Michael
Mm-hmm.
Episcope, who, he runs a
Yeah.
family office and they have private funds. I
Yep.
appreciated Michael's honesty about it, running a
Yeah.
private investment firm. And he
Right.
basically told me we're looking at publicly traded REITs real hard because they offer very strong value on a
Uh-huh.
relative basis. So, I mean, at what point, if you mentioned private deals or like multifamily deals, they're beginning to make sense. It's not like you're being teed up for a fat pitch, though, right? But it's like
Yep.
beginning to make sense. But at
Mm-hmm.
what point do you look at publicly traded REITs and say, well, with this discount to book value,
Yep.
it's weird. It's almost like there's a liquidity penalty right now with
Right.
commercial real estate.
Right. Yeah. No, I hear you. I look at REITs as just two different animals. Like I know the underlying asset that it's priced to is supposed to be reflective of whatever, the stock price is, but I think that
Yeah.
there's such a big disconnect between the two. Theoretically, sure, like if you're an opportunistic buyer and you want to own stock and maybe build up like a portfolio on REITs, there probably is a discount to the inherent value. But it's not something honestly that I think about that much because when I see if there's a company that I like there are certain companies REITs that I have a lot of respect in the industry for what they're doing, and I see their stock is pretty cheap right now, so then maybe I'll go and just buy it just because usually if it's something it's in a kind of vertical that we're not active in, but I don't have like a real opinion in terms of we should build up a whole REIT portfolio within kind of like the office. I just I don't view it that way. I just see them as so different. Like they're such different animals, like the liquidity, but also the volatility from the stock, from the market, and then also the ability, the benefits you have when you're invested in private real estate from a tax perspective. And
Do you think that control is a big element for families too, who are, they might be looking at REITs for real estate exposure, but then
mm-hmm.
they're also looking, co-investing with a firm
Yeah,
like yours? Do you think it's the lack of control that might kind of scare them away from REITs? It's just they're just more comfortable going with a
yeah,
private operator?
I think so. I mean, like we're a relationship driven, like like, and I don't mean that in like the like teach way of where like we like our investors, they text us, and you can't text the CEO of the REIT and say, hey, are you guys selling that property? And so our investors, especially our large ones, they become real partners in these deals, and you can't get that in the public markets. I mean, first of all, I don't even know, they're probably prohibited from speaking to you.
Yeah, well, yeah, that's a good point. Okay, well, I know we've been talking for a while. I want to be respectful of your time, but you mentioned you're not really in the business of making predictions. But I
Sure.
would be curious, maybe you're more like a captain of a ship and you have to be prepared for different types of weather or something.
Yep.
What do you expect in the second half of this year? Do you think that, especially in multifamily or another kind of, the bigger sectors of CRE, do you expect asset prices to be a little more attractive later in the year? Do you think you'll be more active later on in the year?
Yeah. So, well, let me just answer it by saying that we are looking very seriously at raising our first fund. We've done, tons of deals and private syndications, and we're looking at doing our first fund right now because we are saying basically if there will be opportunity within the next 20 years, it's going to be right now. And, I don't know that I don't know about this blood on the streets and distress and all that stuff. It would make a ton of sense because it looks like, it's coming. But we do know that right now numbers are looking much more attractive than they have for a very long time. And so we are in acquisition mode and we will continue to look at stuff. And I think that there will be opportunities for people who are on the ground with the right relationships. I mean, we have people calling and speaking to every broker and all the owners in our markets all the time because I don't know that it's going to be this huge 2008 event, but I think that whenever there's some sort of disruption, there's these dislocations that all of a sudden interesting things happen. By the way, the last time this happened was in COVID, even though prices shot up in April, in May after COVID hit is when we did some really interesting deals because nobody else was playing.
Yep.
And so we had some interesting things happen. And it wasn't that there was this major distress. It's just little dislocations. If you're in the market and you have boots on the ground, you're able to find those dislocations. So we do expect those, we think that that's going to happen and we think we're going to be able to buy some stuff.
That's awesome. I just love talking with a family office, talking about we have dry powder. We're
Mm-hmm.
teeing up to do deals because there's been so much dry powder on the sidelines with
Yeah.
family offices.
Yeah.
And I remember talking about it. We were at a family office conference. This would have been October, I think, of last year. And we were talking about the dry powder. And it's just
Mm-hmm.
like, I think we're going to be waiting, but
Yep.
we're not going to be waiting 5 years, obviously,
Right.
so
Yep.
it's more into 2023. So I really respect that. And, the fact that, again, that long-term philosophy, you're
Mm-hmm.
willing to be patient,
Yep.
and let the right deal come along because
Yep.
those are the best deals, when you wait for the
Sure.
truly good deal rather than reaching, I just got
Right.
to do a deal.
Right.
So that being said, I understand you're teeing up to launch a fund at some point soon. Where can our audience of high net worth investors and family offices go to learn more about HLC Equity?
Sure, definitely. So we would love to connect with anybody. First of all, on our website, there's tons of information. You can just go to hlcequity.com. There's a place to sign up there. We will, if somebody wants to send a note there, we will get back to you very quickly. That's another thing is we try to be as prompt as possible in all of our response times, especially with our LPs. And then I'm happy to connect with people on social media, primarily on LinkedIn. So look me on LinkedIn, Daniel Farber, and more than happy to connect with everybody. And yeah,
Thanks, Daniel. We'll be sure to link
great,
to those, the website and your LinkedIn in our show notes as well to make it
perfect.
easy for our users. And thanks again for coming on the show today.
All right, thank you. Thanks a lot.